investing in yourself is always going to be the highest rate of return, especially early in your career. I mean, the more skills you can learn now, 8 or 10% is nothing compared to building a business or a brand that people recognize and that you can monetize later on.
Hello everyone, my name is Dr. Dylan Callier. I'm a physical therapist, and welcome to the New Medical Nomads podcast, where I get to document my journey as a medical traveler, as well as interview other experts within the traveling field. Now, the rules for the traveling game are constantly changing, so anything you hear on this show should be for entertainment purposes only. This is not legal, financial, or medical advice. Enjoy the show and safe travels. Hello everyone, and welcome to another episode of the New Medical Nomads podcast. Today I'm with Dr. Casazza, and this is number 2 of our little financial mini-series that we have going on. And today we're talking about investing as a traveler. I know the last one was a little more dry than talking numbers and things than some of these usual podcasts. So if you're driving, you might want to save this one for later. Get your notebook out. We're not professionals or tax advisors or CPAs or anything of that nature. Just kind of talking about what we're going through, what we're doing, and maybe hitting off the light bulb in your head for options that you have going on. But Jared, did you have anything that you wanted to start out with the investing? How did you get into it coming out of school?
Coming out of school, along with looking at all the different repay or pay as you earn and student loan repayment options, that's when I really got into looking into different investment options as well. And since then, I can't even tell you how long I've spent reading and learning and listening to podcasts and things. But a lot of that is because it's something that I enjoy. It's not something that I had to do to learn what I did. Mm-hmm. I really could have done a lot less, but I still enjoy listening to finance podcasts and stuff. So, but kind of like what I was talking about in the last one was the biggest thing with anything to set yourself up in a good financial situation is to create the biggest gap between your income and your expenses. And as long as you're doing that, there's almost no bad options for investing. If you're saving a big percentage of your income, then you're going to be in good shape no matter what you do. And so that's always the most important thing.
Very, very good. So the last episode, we kind of got into the differences between finding a financial advisor to kind of make those decisions of where you should put those investments versus going off on your own and making those decisions. If somebody out there listening is not wanting to go the financial advisor route, what are their options and how would they go into finding those investments or finding those certain types of funds in order to just start allocating money towards that?
Yeah, there's a lot of very good forums that you can go on. So like in the last episode, we were talking about the Bogleheads book. There's a whole Boglehead or Bogleheads forum where people talk about different asset allocations and things like that. So, asset allocation seems like sounds like a scary term, right? But it's really not a big deal. It's just talking about what you're investing in, like as far as domestic stocks versus international stocks versus bonds and things like that, and what percentage you choose to put in each one. And everyone has their own opinion on those things. So you do want to come up with some kind of asset allocation. Mm-hmm. It doesn't have to be anything real difficult. Like a very easy way to start out would just be to go 80% stocks, 20% bonds. And I don't think anybody would argue with that for somebody coming right out of school. So don't let that deter you at all, or think that you need to have an advisor because of that. And the index fund investing, there's hundreds of domestic stock index funds that you can invest in, and there's hundreds of domestic bond funds that you can invest in. So I would say somewhere around an 80-20 allocation and investing in low-cost index funds is probably a very easy way to start. And from there, you can get as complex as you want, or you could pretty much stay there for the majority of your life and never really have to change.
Got it. So say I'm coming out of school, or even somebody early in their career, and I have some cash and I'm wanting to go out and buy some index funds. What websites do you go to in order to make those purchases, or where would I go to buy bonds?
So there are a lot of different brokerages that you can go to. There's Vanguard's probably one of the most popular ones, and it's the one I choose, but there's a lot of other good ones as well. There's Schwab, Fidelity, another one that can't think of right now. But there's a bunch of different brokerage accounts that have index funds built in, and there's a lot more index funds than just what I mentioned. But probably one of those three would be a good place to start. So you go in there. It's very simple to open an account. Once you open an account, there's endless options that you can choose from as far as investments. You can invest in individual stocks, you can invest in mutual funds, you can invest in index funds. As far as index funds, if you just Google like S&P 500 index fund for Vanguard or for Schwab or for Fidelity or anything like that, you'll find the symbol for it that you can type in, and you can buy that. Same thing with the bond funds. You just search for Schwab bond index fund, and you'll find that symbol and put that in, and just invest your money in those two. Really is the easiest way to go about it.
Mm-hmm. Very good. Yeah, even though that I went with a financial advisor, I did kind of get into making investments on my own, just to kind of go through the experience and see how that happened. A little story. I remember when BP had the big oil spill. I was in high school when that happened, and I was just interested. And I went and looked at the stocks, and you see this big oil company just plummet for their stock prices. And at the time, unfortunately, I didn't know. And I was in high school. I didn't have a lot of funds, but if I would have had like just $200, I could have put towards that. I could have doubled my money, because a big company like that I knew wasn't going to go anywhere, and that it was just a temporary dip. But I could have, invested in that and gone up. But
yeah, well, anything like that, and individual stock investing is it's a dangerous game. I really wouldn't recommend anybody do that.
Yeah.
I had a period of time where I got kind of really interested in stock and value investing, and looking into stock valuations and things like that. And I thought that I had a very good handle on it, and I still think I have a good handle on it. But the problem is to do enough research to make informed decisions. It's almost like another full-time job. So in reality, you might get a little better return if you really learned a lot. But is it worth spending 20 hours a week doing that? Probably not. So if you can get an 8 to 10% return probably in an index fund over a 50-year period or something leading up to your retirement, then why not go that way when you don't have to spend any time on it? And the thing about, some of those dips is a lot of times they do return back to where they were. Most things mean revert. So when there's a big drop like that, they'll come back up to pretty close to where they were. But, the thing with BP is at that time, I remember I think I was like 1 or 2 years out of high school. And I remember watching that and thinking the same thing. Like, I wonder if I should invest money. Because at the time I had, I think I had about $10,000 saved. And I was thinking about investing in something like that. And, but you never know. BP, even though they're a huge company, that was a huge thing, and they could have gone out of business from that. And if you'd put your $200, you could have lost it all. So it's always risky for sure.
I laugh at that now, but yeah, that was a lot of money back then.
Yeah, I know.
That's a lot of minimum wage hours, mowing grass and working on roofs. I've been told that by a lot of different people that day trading is not something you want to get into. The only people that seem to do it are day traders, and they're just so set in their ways and just so stubborn. But what I've heard on several podcasts, and I don't have the resources on the top of my head to say where I've heard this, but I believe it's only like 14 days out of the year that actually matter. It might even be less than that, to where there's a dip and you want to buy in then and then just quickly sell it. And if you're working during that time, if you have basically a full-time job anyhow, you're most likely going to miss it.
Yeah.
And those 14 days or whatever that number is that actually matters, you're not going to make it. And so you're actually going to end up losing money over time. if you actually track your progress and track what it would have been versus just going with an index or just going with a financial advisor.
Exactly. And how sad is that if you spend a lot of time and then you end up with a lower return? Like that's that really stinks. So I'd highly recommend that nobody go that route. You know, we make pretty good salaries in healthcare. So spend your time making more money instead of spending your time reading about stocks and trying to determine if things are undervalued and stuff like that.
I imagine there's going to be some day traders out there that are going to reach out to me, but I welcome your opinions. Something, and this was actually coming from Will Butler that we were talking in the last episode. I was talking about some different options coming up and things that I wanted to do within this upcoming year. And I was talking about how I almost felt guilty pulling out some of that money that I had allocated towards index funds and different things like that in order to kind of develop this podcast more, in order to put towards website. And he said, no, don't feel bad about that, because if you take that money, invest in yourself, say, you know, if you create a product or put it towards something else, like you earn more skills as either a therapist or some type of other CEU course for health professionals. If you're able to gain more that way, you will always outbeat the market from what you could get with that 8 to 10% normal return on an index fund.
I would definitely agree with that.
Yeah.
So the return on investment, investing in yourself, learning new skills, building a brand, building a website or a podcast or anything like that will grow exponentially in the future is way higher than any kind of return in the stock market. You know, 8 to 10% is nothing compared to early growth in a business. So investing in yourself is always going to be the best return on investment, as long as it's something that leads to a big return.
Absolutely. And I would argue, even with those who aren't interested in owning their own business or doing anything like that, that taking that money and instead doing a CEU course that might give you some type of licensure that would get you that next job that's going to pay X more than the previous one might be a fairly, I would say, arguably better return for investment versus sticking that money into a typical investment that you would find, whether it be an index fund, I.R.A, Roth I.R.A, things like that.
Yeah. So, you know, basically, like I said in the last one with the long-term disability insurance, the biggest asset you have is your ability to earn money and earn more money. So yeah, a $2,000 or $3,000 raise on your salary is going to be a lot more important than a 8 or 10% return on your investment.
Absolutely. Very, very good. And bringing up the IRAs, would you want to just kind of give a brief overview of what an IRA is, and then what the difference between like an IRA and a Roth IRA are? And we'll talk about other options as well.
Yeah. So an IRA is an individual retirement account, is what that stands for. And basically they're these accounts created by the government to encourage people to save for retirement. And the way that they incentivize these accounts is by giving basically a preferential tax treatment, or they reduce your taxes. So a lot of people talk about the Roth IRAs being very important early in your career. And the reason for that is, so I'll talk about the difference between the two. When you invest in a traditional IRA, the money comes straight out of your paycheck with no taxes and goes right into this account. And then while in the account, it grows tax-free until you withdraw it. When you withdraw it, you pay taxes on what you withdraw. So the benefit of that is that you have, say you're 20 years old, you retire at 60, you have 40 years where the money that you would have paid to taxes is compounding in this account. So that's a huge benefit. Compounding interest is an amazing thing. It's hard to wrap your head around without actually doing calculations on an Excel spreadsheet or something. But when you do, it's amazing to look at. So that's a big benefit. The Roth IRA, you pay taxes up front. So you would still pay taxes just like ordinary income. The money goes into this account, and then when you withdraw it, so 40 years or so later, you don't pay any taxes on it. So the benefit of that is you pay up front. You don't have to pay anything on those earnings over that 40-year period or whatever. You're paying $0 in taxes on all those earnings. So that's a big benefit. So what most people will tell you is that to choose between the two, you look at your income now compared to your income in the future. And if you're going to be making more now, then you'd want to invest in a traditional IRA because you'd have a higher tax bracket currently. If you're thinking that you're going to be making more in the future, you want to invest in a Roth IRA because then your tax bracket's going to be higher in the future. So you don't want to be paying the additional taxes on that money later on. The problem with that reasoning is most people, I would say, are going to be, you don't compare your tax bracket now to your tax bracket later. So I wouldn't be comparing, say I want to retire at 65. I wouldn't compare my tax bracket currently to my tax bracket at 64 right before I retire, because chances are for most people, your last few years of work are going to be your highest earning years. So obviously, yeah, if you were comparing those two, then chances are you'd want to invest in a Roth because you're going to have a higher tax bracket later. But that's not what you want to compare to. You want to compare to what your tax bracket's going to be in retirement. So, and the cool thing about when you get to retirement is that you can kind of control your tax bracket a little bit because you only need to withdraw from your investment accounts what you need to live on. So let's say that you make an average income throughout your working career of $60,000 a year. But your entire working career, you're only spending about $40,000, right? So that extra $20,000, some goes to taxes and the rest you're saving. So that means in retirement, to continue your lifestyle, you only need to withdraw $40,000. So obviously, your tax rate is going to be lower on $40,000 in retirement than it's going to be on $60,000 while you're working. So those are the numbers you need to compare. What are you going to be paying in taxes in retirement to maintain the quality of life you want, or the standard of living that you want, compared to what are you paying in taxes now? And by using those two to compare, you can kind of determine which is better, a traditional or a Roth.
Got it. Yeah, and that's kind of that. The Roth IRA was the first ever investment that I had actually made, and that was back in high school, just putting in the bare minimum that I could, just in order to start that process, get used to putting away some funds, and then not only building the habit, but also taking advantage of that accruing interest. And there was a series of financial papers that I read by a guy named Leon Johnson that always came to the student conclave for physical therapists and gave a big presentation. And I'll see if I can't find those and put them in the blog post, but it gave a really good picture of what accruing interest was. And I forget the example, but it's like 23-year-old Sally starts putting in $1,000 per year and stops when she's 40. And then John puts, 10 grand a year or something like that, starting at 40 until he retires at 60. And who do you think is going to come out ahead? And just the moral of the story is that when Sally started earlier, even though it was much less and she stopped sooner than when John started, that accruing interest just built up over time. And then she came out not only ahead, but well ahead of option B.
Yeah. And that shows, that shows the power of compounding. And when you just give that example without looking at the numbers, pretty much everyone would say that the person investing more money would come out ahead, even if it's later in life. But, compounding is such a crazy thing that we really can't understand it. Our brains can't really comprehend how quickly money grows when it's compounded. So yeah, you need something like a financial calculator or a spreadsheet or something to really understand the difference. One other thing I'd like to say about the Roth versus traditional, and I've written a couple blog posts about this because there's a kind of a misconception on which one comes out ahead. So most people say that a Roth makes more sense. I would say that having the most flexibility makes more sense. So probably a combination of the two, having some pre-tax accounts and some post-tax accounts. So some Roth, some traditional would probably be the best. But one thing that really skews things in favor of a traditional account over a Roth account is the fact that during your working years, when you put money into a traditional IRA or a 401k, most 401ks are traditional accounts as well, so they're pre-tax accounts. That is reducing your marginal tax rate, which means that any money you put into that account is coming off the top of your tax rate. So if you're in the 25% tax rate and you put $5,000 in this account, you're saving 25% in taxes, right? in retirement, when you're taking money out of that account, if you don't have any other sources of income, the money starts at zero and comes up to that marginal tax bracket, which means that it's not being taxed at that marginal rate. So even if you, let's say that you make $80,000 when you're working, and in retirement you want to withdraw $80,000. Logically, it would seem like traditional or Roth would be the exact same. Whether you choose one or the other doesn't matter. You're gonna come out about the same. But in reality, that's not true, because to get to that $80,000, you have to fill up the bottom tax bracket. So there's basically a 0% tax bracket because of the standard deduction and personal exemption that you fill up first, and then you go into the 10% bracket, and then the 15% bracket, and then 25% bracket. So even though you would end in the 25% bracket, your actual effective tax rate that you're paying on that 80,000 is way less than when you put that money in. So that heavily skews things in favor of a traditional IRA. And I wrote about that, and I'm sure you guys are like, I can't understand that at all. It doesn't make any sense. And that's what most people said. So because of that, I wrote another blog post that actually put numbers to it. And, if you go back and if you are interested at all and you look at that blog post, I used two people with the exact same income, same savings rates, everything. And it shows how, for most people, a traditional account comes out ahead, even though intuitively it doesn't make sense because of this marginal versus effective tax rate.
Got it. Yeah, I'll be sure to get those blog posts and be able to, I don't know if we should put them all individually down there or just flood the listeners towards your site, because I know there's a lot of good information in there, and just a lot of stuff to wrap your head around.
I think I've written 3 or 4 posts now just on traditional versus Roth accounts.
Got it.
So yeah, there's a lot on there.
And I can say that's definitely different than what I was told, even starting in high school. And that's not just coming from, my parents and family. That's coming from the advisors that my parents had, that my dad had.
Yeah, and the thing about it is, intuitively, it doesn't make sense. You would think that a Roth account would be better. And it's not until you actually run the numbers and you think about effective versus marginal tax rates that you start to realize that it doesn't really make sense to invest in Roth. Unless you're in the, like you were saying, high school. Yeah, Roth account is always the way to go, because your income's so low that you're paying 0 taxes on it anyway. So in that situation, you're paying 0 taxes when it goes in, and you're paying 0 taxes when it comes out. Like there's no way to get better than that. But it's particularly in your high earning years, or not even high earning years, but when you first start your professional job, that it becomes a question of which one you should actually invest in, because they seem to be pretty evenly matched. But if you run the numbers and you look at effective versus marginal tax rates, it usually skews towards the traditional.
Got it. And kind of going along the lines of items that you can deduct from your taxes. Things I have heard are also 401ks and then HSA accounts. Could you go into those?
Yeah. So 401k is it's the same thing as our traditional IRA, basically. The only thing that's different is that it's an employer-sponsored plan. So an IRA, a traditional IRA or Roth IRA, can be opened by anyone. A 401k is only it's only an option if you have a job that offers a 401k. Or if you're self-employed, you can open your own solo 401k or something of that nature. Some companies will have the option of either a traditional or a Roth 401k. And in that scenario, it's the exact same thing as choosing between a traditional or Roth IRA. The only thing that's different is the income limits, not income limits, the contribution limits. So currently for 2017, the maximum you can contribute to a 401k is $18,000. And that doesn't include employer matches. The maximum you can contribute to a traditional or Roth IRA is $5,500.
Okay.
And you can actually open both of those accounts. So if you opened a traditional IRA and you maxed out your 401k, then you could put a total of $23,500 into tax-free accounts that subtract off of your highest marginal rate and bring your income down, which not only does it save you taxes, but it also will reduce your student loan payment, which we talked about before. The HSA is the best account that you can choose, because unlike a traditional or Roth account, traditional, like I said, you're not taxed up front, but you're taxed when you withdraw. A Roth, you're taxed up front, but you're not taxed when you withdraw. So either of those, you still get taxed at some point. There's no way around that. with an HSA, you're not taxed when you put the money in, and you're not taxed when it comes out, as long as it's for a medical expense. So if you have an HSA option, it's crazy not to put money into it, because, and even if you say, so right now I think the maximum for HSA is like $3,350 a year, and even if you don't have that many medical expenses, if you make it to 65 and you still have a lot of money in your HSA, you can withdraw that money just like a regular retirement account.
Wow.
So
Okay.
there's really no downside. And in addition to that, as we all know, working in medical field, your medical expenses are going to be a lot higher after age 60, 65 anyway.
Mhm.
So chances are you'll use it, but even if you didn't ever use it on medical expenses, you could always just withdraw it anyway.
Got it. And the HSA would just be another option for health insurance, correct?
HSA is basically, it usually only is available in high deductible plans, or it is only available in high deductible plans. So if you have a low deductible plan that has a higher premium, a higher monthly payment, then you most likely won't be eligible for an HSA. But if you have a high deductible plan with a lower premium, then you should be eligible for a HSA.
Got it.
And the HSA accounts, when you sign up for your health insurance, it will tell you if it's eligible for an HSA. So it's not something that you just have to figure out on your own. It'll tell you if you're eligible, and it'll ask you how much you want to contribute monthly. So it's a very good option for most people. And another thing that I'd like to mention, for at least financially, when you're young, your medical expenses are very low, unless you have some kind of chronic condition, or you are unfortunate enough to have some major injury. It almost always makes sense for you to have a high deductible plan anyway. So when you're young and you don't have a family, or if you have a young family or something like that, it makes a lot of sense to choose a high deductible plan and invest as much as you can into that HSA.
Got it. Running through the questions here. Do you take advantage of 401k options offered to you by the traveling agencies?
So if your travel company offers a 401k, I would say that whether you choose to invest in a traditional I.R.A. or a 401k would depend highly on how long you plan to travel with that company. The reason for that is 401ks are limited in their options. So you're going to have just a certain number of funds that you can invest in. And usually it's a pretty big number. It would be like 30 or 40 funds that you can invest in. But with an individual I.R.A. or an individual retirement account, you have unlimited options. You have thousands of options. And you're not locked into just those certain choices. So if the reason to choose a 401k over a traditional I.R.A. would be that your company has 401k matching. A lot of them do. I know the company I'm with has 3% matching, basically. So if they have matching, that's just free money. You definitely want to contribute up to the match. If you're not going to stay with them long enough. So there's something else called vesting periods, which go into 401k. Basically, a lot of travel companies will have this different vesting terms. And what that means is if you don't reach this vesting period, you don't get to keep all the money that they matched. So your contributions, you always get to keep no matter what. But say they match 3% and you work with them only 2 years and they have a 3-year cliff vesting schedule. That means that after 2 years, if you leave, you don't get any of that match. A lot of companies will have more of a tiered vesting schedule, which means that after 1 year, you would get 20% of what they match. 2 years, you get 40%, 3 years, and it goes all the way up to 5 years. So a lot of it depends on whether you plan to stay with that company long enough to even take advantage of any of that match. If you don't plan on that, then yeah, go with a traditional I.R.A., max that out first, and then any extra money you want to invest, put that into the 401k, because you would still get the preferential tax treatment. But I would say for the majority of travelers that are only going to travel for 1 or 2 years, then it probably makes a lot more sense to just open an I.R.A. and invest in that.
Got it. And so something that has been recommended and something that I am doing myself is, in order to cast as wide of a net as I possibly can starting out and finding the position working as a physical therapist as I can, that would be best suited towards me, I'm working with multiple different agencies. So I've accepted my first position, and then after that position, I will still work with those same agencies. And then whoever I'm able to find the best position for me, I will accept. If I were to go with that 401k with this first company, is it a large headache in order to get that money transferred to a new 401k? Are there penalties? Are you aware of people doing that, kind of bouncing between companies like that?
So, yeah, I do the same thing. I have probably about 5 different companies I've communicated with now, and I always look for whichever one can offer me the best job. So that's always my main determining factor. I wouldn't let the 401k keep me straddled to a company that doesn't have the best options, right? So that should always be your main concern. As far as rolling the 401k over, it's really not hard at all.
Okay.
I had actually my first travel assignment, I took a PRN job, and they offered a 401k with a very high match. So I contributed as much as I possibly could to that. And when I left that job, then obviously I had to roll that money over into something. It wasn't a very high amount. So whenever if you're in a situation where you're going to be bouncing around, you want to save more than that 5,500 that you can put in a traditional IRA. I would invest in the 401k and then rolling it into your traditional IRA. And it's really not a very hard process at all. You just if you already have the IRA open and you've already been investing in it, then you just contact your 401k plan administrator and give them the account number and things for your traditional IRA, and they just roll it right in. And it's a pretty easy process. It's not very hard. There's no penalties, nothing like that. So I would still recommend investing in a 401k in that situation.
Okay. So you'd be able to roll it in, but I imagine that you wouldn't get those matching options because you didn't make the vesting period like we were talking about.
Yeah. If you had a company that had a tiered vesting approach, like I said, like 1 year, 20%, and you stayed with them 1 year, you'd only get 20% of what they matched, which is still better than nothing. But yeah, if you only did one assignment, then you wouldn't get any of the match. Unless most companies, or at least the ones I've worked with, they'll have a clause in there where if you come back, you pick back up where you were with the matching. So in that scenario, if you were going to be bouncing around and you went back to the same company for 4 more contracts, then it might make sense to leave the money there and then pick up back where you were and continue that way.
Interesting. Yeah, I was not aware of that option, and I imagine that's going to be different for every company. So I'm not going to ask any questions about that. You can approach your recruiter about that, and hopefully they can send you to the right people within their company to kind of figure that out for yourself as a listener.
Yes, definitely.
Very, very good. And then we also had some more questions here from the listeners that wanted us to ask. So my girl Carissa Weller, who was on the podcast, she was asking, can you talk about your preferred investments when working part-time versus full-time? Do they differ? And I assume that means when you were working, I don't know if you've done it yet, but working part-time throughout the year versus full-time, would that change your investment strategy?
It might change whether you choose a Roth or a traditional account. As far as like what I recommend for investing in index funds, it wouldn't change that at all. I would say, and another thing to consider is when you invest in your traditional IRA or your 401k or whatever, most companies or most plan administrators for the 401k will have index fund options. So when I say invest in your 401k, that's not just I think a lot of times people don't understand that your 401k is just like a bucket, right? But inside that bucket, there's options, just like you'd have in a brokerage account. So you can still invest in index funds inside your 401k and inside a traditional IRA or whatever you choose. But as far as changing, you'd have to look at your income in those years when you work part-time and determine if a Roth makes more sense. And like I was saying, if you have a very, very low tax bracket, so if you're in the 0 to 10 or 0% bracket or the 10% bracket, if you're working that little, then a Roth might make a lot of sense. But if you're up in the higher income brackets, then probably a traditional account makes more sense. And, I guess I want to talk a little bit about index fund investing because, we mentioned it and it seems very simple. And the fact is it is very simple. It's a really simple strategy to use. And everybody thinks that investing has to be difficult. And that's what I thought. I was like, oh man, I really want to invest, but you know, it's a lot of hassle to do that. And like we talked about earlier, it's really simple. You just go open a brokerage account and you pick the index funds and you put money into it. And you can set up an auto draft from your account where it automatically goes into the account, and it's automatically invested at those asset allocations that you chose. And it really is that simple. So don't let anything like thinking that, that investing has to be complicated hold you back from investing, because as you mentioned in that compounding example earlier, starting early is the most important thing. So even though it seems simple, it really is simple. There's a lot of books on it, on index fund investing, and it's a very simple process. You just open the accounts, put the money into it regularly, and let compounding work.
Absolutely. And that would be for the long-term game, to where you're not looking at those, you're just putting that. And I like the automatic payments because then I don't even see that money, and it's just, it's gone. What I'm trying to think of that oven commercial, the set it and forget it.
Yeah.
Where you're just plugging the money in, you're not thinking about it. And then, you know, whenever your retirement comes and you're starting to pull out of those investments, that's when you check in and you're like, oh, wow, I got a lot here.
I wrote a blog post on my history with investing. And like I mentioned earlier, when I was probably about 20 years old, I had saved, when I went to community college, I worked full time, and I saved a lot of money then. So I'd saved somewhere between $10,000 and $12,000, and I was like, oh man, this is awesome. I really need to invest this now. I need to do something with it. But I had no idea back then. I mean, you know, that was 10 years ago. The internet was like a lot newer than it is now, I guess. And, I didn't know anything about searching for things, and I didn't have the initiative to do it anyway. So I took my money to this fund manager, and I told him, like, you know, I just want to invest this. And he was like, well, what do you want to invest it for? Are you planning to buy something with it? And I was like, no, just for the long term, I want to invest it. And so he invested it. I had no idea what he invested in or anything like that. I didn't follow up with anything. Well, the sad part is this was in the beginning or the middle of 2008. So I invested about 10,000 or 12,000 after I kept adding to it after I invested it initially. And then all of a sudden, 2009, I checked the account and I have $6,000, right? And I was just panicking. I was like, man, I spent so much time earning all that money, and then now it's down to $6,000. And I didn't know enough back then to realize that those fluctuations happen. You know, 50% is a big drawdown. It usually doesn't happen like that, but that does happen sometimes. And so the important thing to remember is that, yes, this is any investing that you do in the stock market is a long-term game. Year to year, there's huge fluctuations. But long-term, you should expect like an 8 to 10% return, and that's what you're shooting for. So you put the money in there. You don't check what the stock market's doing constantly, because that'll drive you crazy. You leave it. You plan to take it out in 65 years or whatever. It's not for short term. If you're planning to buy a car with that money in like 2 or 3 years, then the stock market's not the place to put it. You want to use a CD or a savings account or something that's more safe, because there can be a 50% drawdown at any time.
Got it. And that's something that was just described to me by my financial advisor, that say I turn 65 or whenever I retire, much earlier for you, I know, and we'll get to that in the next one, which is super interesting. But if I were to get to that time where I'm retiring and I try to pull out, and that it's during the year 2008, and there's that big dip, that you want different options. So you want some in the index funds, you want some of the I.R.As, and just different avenues that you can pull out of, so that if that bucket is really low, that's not the one you're trying to pull out of, that you have other options to pull out of as well.
Exactly. And, you know, at the beginning of this, when I was talking about a 80-20 allocation between stocks and bonds, what you would do when I say 80-20, I don't mean that, that you would just start with that allocation and then you would just leave that forever. So basically, once a year, which is, you know, not that often, but once a year, you would go into the account, you would see what happened over that year. So if stocks had a really good year and they're up 15%, then obviously it's going to be out of balance a little bit. And then that's when you would adjust. And the reason that you want to have that adjustment period where you're coming back to your original allocation is because all asset classes in general mean revert over the long term. So if stocks have a really good year, and bonds have a really bad year, you want to move money from some of the money from the stocks into the bonds, because chances are stocks are going to come back down and bonds are going to go back up. So having that asset allocation that you adjust every year is very valuable, because like you're saying, when one of the asset classes is down, ideally one of the other ones will be up, and you put money back into that one that's down, so that when it mean reverts, you increase your return.
Absolutely. Very good. And Dr. Kelly Berg had a question, who is also on the show. And I think we kind of touched on this already, but options to invest in index funds without using an advisor. And we had talked about just going with the brokerage accounts and opening up a profile, basically inserting your bank information, finding the little 3-digit or 3-letter company that you're wanting to go with, or index fund, and you just plug it in and hit save and have it repeatedly pull out every month. Have you dabbled with any other investing opportunities outside of indexes and brokerage?
No, I've thought about investing in real estate, and I've saved a lot of money in cash now to possibly invest in real estate. But so far I haven't made any big investments in that. I have put some money into different personal loans, basically into businesses and stuff, friends I know, which probably is not the best opportunity for most people, but it just depends on your situation. So I would say that index fund investing is probably the best way to go. It's the lowest return, and you have low risk. I'm sorry, not the lowest return. It's the highest return for the amount of fees, and you have the lowest risk.
Got it. Yeah, I've had similar situation, just some friends who work with some businesses, and a big enough business to where it's publicly traded. So you get in, I can put in a couple, 1,000 in there just to see what happens. Do that. And then the big buzz right now is Bitcoin. So you haven't thrown down any money at Bitcoin yet?
Well, Bitcoin is a highly speculative thing, so I wouldn't recommend people put much money into it, especially how much it's gone up recently. Mm-hmm. I would say that if you want to invest in it, use a very small portion of your total net worth, probably somewhere between 1% and 5%. Like that would just be almost like play money, basically. You want your main investments to be in index funds that you're not going to have such high risk. But Bitcoin is jumping so wildly right now that you could invest it. I think it's 17,000 now. You can invest 17,000, and it could be back to what it was 6 months ago. It was like 7,000.
Yeah.
It's I've considered putting maybe 1 or 2% of my assets in there, but so far I have not.
Yeah. Got it. So I know we made a priority list last time, but priority list of investments after you take care of your savings, long-term, short-term disability, school debt. What was the fourth one? Oh gosh.
Investing in index funds.
Yeah, there we go. Index funds. Then you got your I.R.As. Probably would you say they're on the same step there?
Well, kind of like I was saying earlier, an I.R.A. is going to have different options in it. And so just because you're investing in an I.R.A., that's the bucket that you're choosing, but you would still choose index funds inside that I.R.A. ideally. Got it. So yeah, I would say that the first three, saving for any emergencies, short and long-term disability coverage, and then whether or not to pay down your debt or invest is going to be individual for each person based on your interest rates. And but I would say the majority of your investing should go into those, either a Roth or traditional account, whatever you choose is best for you. Because the income limits are huge the contribution limits are huge. So the chances of you maxing out both of those accounts early in your career, $23,500 for most people is low. So I would put the majority of your money into those accounts and let it compound for 30 or 40 years, and chances are you'll be in a very good situation when you retire.
Yes, I would agree. And then followed by Bitcoin, and then followed by taking a trip to the casino.
Yes.
All right, Jared. I think that was all the questions for the investments. And then the next episode that we're going to talk about will be financial independence and retiring early. So I'm super excited to talk about that. Where could the listeners go in order to hear more about the information you're providing, and where would you'd like them to go in order to ask questions?
My blog is where I write about everything. I've been writing about financial independence and investing and retirement accounts and things like that for probably about a year and a half on there now. So if you have any questions about any of that stuff, my blog is fifthwheelpt.com. Fifth wheel spelled out, and then PT is abbreviated.com. And you can always ask me questions. You can find my social media on there. Feel free to send me a message with any questions you might have.
Absolutely. And I'll be adding you to the New Medical Nomads group on Facebook. I have all my guests on there. So if any of the listeners have a question for you or any of the other guests, they can find them in there. Just shoot them a question in the group. That's kind of safe, where I get to moderate everything. There are recruiters in there in order to answer any type of recruitment questions, but they're not going to bombard you with offers and things like that until you're ready. And so if you're looking for the next official launch for the third part of our little mini financial series here, that will be launching on the New Medical Nomads podcast Facebook page. And then if you want early access to the next episode as well, you can find it on YouTube, iTunes, or Stitcher. I usually upload it there about a week or two in advance. And that way you get the early access to the videos. But if you're listening to this, you learned anything, please drop it below. If you know anybody who you think would benefit from this, please share it. Show us some love, give us a like, give us a comment, anything like that. That will help get our information out there to people we're trying to reach. But Dr. Jared Casazza, thank you so much for sitting down. And we got one more to go in this marathon.
Yeah, thank you for having me.